We have the Bank of Canada.
Yes.
And, Tiffany Macklem,
Yes.
Tiff for short, but the real name is Tiffany. He is in charge there. And you have Jerome Powell of the Federal Reserve in the U.S. Okay. But let's break down the interrelationship between the U.S. interest rates and the Canadian interest rates.
Sure.
Because I think a lot of people are overestimating the Canadian economic numbers and underestimating the U.S. Federal Reserve impacting Canadian monetary policy.
Like we're talking about the $37 trillion elephant in the room.
Indirectly, yes. Yeah. Eventually, yes, the $37 trillion elephant, yes. But I see a lot of people speculating on rates, and they're looking at the price of housing, and they're looking at unemployment, and they're looking at Canadian economic factors, but they're missing the most important factor in their analysis. And so I'm going to break this down, the interrelationship here. So first step here is this is the relationship since the high of July of 2023. So that's when we peaked at a 5% overnight rate for the Bank of Canada. So that was a 7.2% prime rate of interest, 2.2% over the prime rate. And at that point, we had Canada unemployment at 5.5%. Okay. A lot of the textbook definitions will support the fact that if you don't have unemployment reaching 6%, you actually don't have an unemployment problem, because 0% unemployment is not a realistic thing because of transition in the job market back and forth. Like it's just not a practical, sustainable number. Okay. So anything less than 6 is kind of smooth sailing, if you will. Okay. But then we have the Canada CPI, so the fake inflation index, as we like to call it. But it's important insofar of understanding, policy decisions, because it's used in policy decisions. So we're not, understanding that it's real inflation, which we teach in the boot camp, but it's at least the fake inflation that's going to be used in policy decisions. So it's important to keep tabs on it. Okay. Then you have the Canada US dollar, the Canada to the USD. So the 76 cents to the dollar. Okay. So one Canadian dollar could buy 76 cents US at that time, July 12th, 2023. And the US federal funds rate, their overnight rate was very similar at 5.5%. Okay. So they're somewhat aligned here. We have 5%, we have 5.5%, the Canadian dollar, US dollar, 76 cents on the dollar. Okay. Fast forward, and we keep this 5% going. Okay. So we have inflation that's outside of our band. In Canada, it's, the target's 1 to 3%. Okay. So we're over our 3% band. And, we have unemployment that's largely okay at this point. Okay. You fast forward to April of 2024, and now you actually have the first unemployment number that comes in over the textbook number of 6%. Okay. So now we have an unemployment problem at 6.2%. Okay. At the same time, the Canada CPI was actually at 2.69%. Okay. So still within the band. Now it's within the band. Out here, it was outside of the band at 3%, 3.27%. But now we're in our 1 to 3% target. Okay. The Canada to US dollar had deteriorated at that point to 73 cents on the dollar. US federal funds rate was still at 5.5%. Okay. Now, that precipitated the first cut. So Tiffany and his gang decided that we're going to start cutting. Okay. Now they start cutting in the face of this. The CPI has fallen back into the acceptable band of 1 to 3%. And we are facing an obvious unemployment problem. And, we've gone through in previous episodes to discuss the fact that unemployment problem is probably worse than the unemployment rate suggests, but you don't actually have to even look beyond it. Just the headline unemployment rate just defines the problem. It acknowledges the problem, and the data behind the scenes likely suggests the problem is worse than the headline rate suggests. Okay, so that starts the cutting cycle from 5%, and then they cut all the way down to 2.75%. Okay. But what happens in that time is the U.S. Federal Reserve, they keep with their 5.5%. Mysteriously, right before the election, right before the election, they got a 0.5% cut out of, no discernible reason whatsoever. But let's ignore that fact for a second, the political impacts of that.
Not a political decision at all.
And they got another quarter point, right after, maybe just to make it look good. And then they stop. They freeze. Trump's in there. He's inaugurated. They freeze. Now, what happens to the Canadian dollar is the problem is the Canadian dollar when the U.S. federal funds rate is 4.5% and the Bank of Canada overnight rate is 2.75%. The Canadian dollar begins to become the Canadian snow peso. Mm-hmm. Okay. This is the problem and has been the problem since that inflection point where we drop below 70 cents on the dollar. We hit 69 cents on the dollar a number of times. Okay. And that was the go, no go point that Tiffany's boys decided that, wait a minute, we're kind of stuck here. They're confronted with the obviously deteriorating employment numbers. They go from 5.9% taking no action to they're going to 6.9%. The numbers weren't getting any better on the employment side. They were getting worse on the employment side. Okay. So they justified further cuts while they were staying at 2.75%. And the CPI numbers are getting better, quote unquote better. Okay. The fake inflation numbers were coming more in line with the 1 to 3%. In fact, they're entering towards the lower end of the band. If the middle of the band is 2%, predominantly below the 2% number even. So towards the lower end of the acceptable band. But the risks of the Canadian snow peso exists. So, in some respects, it's like, what did you want, Tiff? What did you want the Bank of Canada to do? Did you want them to continue to cut and make it that our dollar was 65 cents on the dollar, 60 cents on the dollar, 55 cents on the dollar? How much goods and services do we import from the rest of the world? Now we would be importing those with the weaker dollar, which in itself is inflationary, which in itself does actually make it harder for the average Canadian to purchase goods and services. So it's not just the rates on the mortgage and the deteriorating housing market. It's like it was the dollar itself. Okay, it was the dollar itself, and I see a lot of kind of economic projections ignoring the fact is like, what is what is this thing that we call money? What is it? Okay. And so, yes, was there, deteriorating real estate conditions in Toronto and Vancouver? Yes. Okay. Was there deteriorating labor market? Yes. But problem is we also had a deteriorating currency and further cuts to the interest rate would have deteriorated the currency more. Okay. And so that's why, we can argue that, Tiff and the rest of the central bankers made the mistake in 2020 and 2021 where they increased the money supply too much. Okay. But at this point, I think like they're stuck. What did you want them to do? What did we want them to do? Keep cutting that interest rate to, turn the Canadian dollar into the Canadian snow peso? Wasn't the right course of action. So they held the line at 2.75%. And if people are wondering like why that happened, it's like, that's the reason why. You don't have to go deeper than that. It's like that's my my job as a fractional CFO is like you try to make complicated numbers simple to people. It's like if they further cut that rate, that exchange rate deteriorates further. End of story. Everything else was white noise.
So is this tied to the bond market?
It is. It's more tied to the U.S. bond market than anything.
I see.
More tied to the U.S. bond market than anything. But that, it's the difference between the two. If I'm holding U.S. dollars, I'm getting a higher rate of return in the bond market than I'm getting in a Canadian. Like that's just what it is. I'm going to get a lower exchange rate. Okay, and surprise, surprise. Eventually, you see Jerome Powell cut interest rates from 4.5 to 4.25, and Tiff does the exact same thing. Is actually Tiff did it first. Jerome Powell did it later in the day. I'm sure they spoke. I'm sure they spoke. Come on, like I'm sure they spoke. And even if they didn't, the odds of the rate cut in the U.S. at that point, I think they were 96%. It was a pretty safe bet, and so that enabled them to make a cut at this point without deteriorating the dollar further as of now. Okay. So what we're doing here is we're establishing the relationship between who has control of the Bank of Canada and showing, trying to show the people that it's not Carney and it's not TIFF that has control at this point. It's actually the U.S. Federal Reserve who has control at this point because they're determining the U.S. interest rate, right? And so what is the most important factor in dropping at this point? I believe it's not employment. Like it's right there. We've known about the deteriorating employment circumstances for a while. We've known about the CPI, entering into the lower parts of the band for a while. Why could they not cut the interest rates? Because the Federal Reserve was not cutting interest rates. It's just that simple. Okay. So, it wasn't Carney or, I think they had, Premier of Ontario was out there yelling at the TIFF. Like, what did you want? What did you want, Mr. Ford? Did you want to turn the dollar into the peso? Like, what were you asking them to do exactly? Right. Do they not understand that, or does it just sound good to the uneducated base? Who knows? Doesn't really matter at the end of the day. Yeah. But what's important to understand is really the Federal Reserve has de facto control over the Bank of Canada interest rate at this point in time. Yeah. At this juncture, that's what it is, right? So now we have to go to the next level.
Okay.
Who has control of the Federal Reserve? So now that we've established why the Bank of Canada couldn't cut despite obvious deteriorating economic circumstances and an obvious CPI within the bands, like why, who has control of the U.S. Federal Reserve?
Well, despite the fact that the Federal Reserve is not federal and there is no reserves. Who has control over that? That's a good question. Let's find out.
Let's break that down.
Sure.
Let's break that down. So there are 12 voting members of the U.S. Federal Reserve. Okay. Chair Powell, he's only one. He's one of the 12 voting members. Symbolically, does he have more influence because he's the chair? There's actual power, there's actual voting power, and then there's, influential power. Okay. But he's one of 12, okay, who can vote. Okay. Recently, Trump has been able to appoint a vacant position. Okay, so he appointed Stephen Moran. Okay, and on the latest Federal Reserve rate decision, okay, there are 12 voting members, and they appointed Moran at the 11th hour. Like he was in there, I think on the 15th or the 16th or something, and like they flew him in for the meeting, and he's like appointed at the 11th hour to come to this meeting. Lo and behold, there was 11 members, reportedly that, were voting for the 25% basis point cut. Guess who was the one dissenter who wanted a 50-point basis cut?
I bet you.
It was the new Trump appointee, Stephen Moran, right? Because Trump has been very, very vocal about how they need the rates to go down. Okay. It's like people are missing the plot on the whole thing. Like they are overestimating Doge. They're overestimating tariffs. They are wildly underestimating $37 trillion of debt in the bond market blowing up. It's like
huge.
We're just underestimating this. I say it with a laugh, but because it's like if you truly understand it, how tenuous the situation is. Like you just start to understand how tenuous the situation is, right? And we'll pull up the one that we pull up, pretty often here. Like we'll pull up the U.S. debt clock. It's like
they're broke. They're just broke. Like there's no hiding it. They're
$1.9 trillion is the deficit every year, and you're not growing this GDP. Like you're not going to grow this by $1.9 trillion. Like I know all the AI bros out there say it's not gonna happen, man. Like you're like, is AI gonna make us more productive? Yes, it's gonna make us more productive, just like the internet did. Is it gonna be like a light switch? It's like, no. It's like, and if you don't believe me, it's like Just try talking to the automated system at, the big telecoms or the bank or something and tell me how smart the AI is all the time. It's like, we got a long ways to go before, like it's not going to happen overnight. You're not going to grow a mature economy by 6, 7, 8%. Like it's just not gonna happen. And even if AI made things way more productive, what happens to all the jobs that are displaced by AI? It has both a positive and a negative effect at the same time. This is not going to be an easy growth pan out of it. It comes down to this interest here. And this interest, you just start rolling this over. If you just start rolling it over at the current Fed's fund rate that's 4.5%, you start getting an interest expense at $1.5 trillion. So you start going from a $2 trillion deficit to a $2.5 trillion deficit, as opposed to what happens, for every 1% that you can get off the interest rate, you're saving $370 billion in interest. For perspective, like all the tariffs combined, probably maybe 300 billion. They're going to increase the tariffs from 100 billion to 300 billion because the tariff revenue in the US was not zero before 2025. People, right. They had tariff revenue, maybe $100 billion of tariff revenue, and maybe they can get it at 300 billion. If the courts don't throw it out, I don't think they will, right? But that's a $200 billion solution to a $2 trillion problem. That's not actually the solution. It's the same with Doge, right? It's like, it's $600 billion worth of savings over what time period, people? Because, at most this was, a $2 trillion problem. It's like, maybe it's 100 billion a year. That's all, because I actually don't like how they put the Doge clock up there, because they put the Doge counter in aggregate, but the rest of these numbers are annual. It's like Doge will save 600 billion over 10 years, 20 years. How much does it save this year? That's what we really want to know. But, obscured from us. And so now so Trump was able to appoint one board member. So he had one dissenter flown at the 11th hour that wanted a 50-point basis cut. Okay. So there's 12 members of the US Federal Reserve. Okay. 12 members. And the argument that we've heard, the line is like, it's not federal and they have no reserves. Well, they certainly don't have any reserves. Like, that's not how it works. They can print money, to go out and buy assets and inject liquidity, and they can let those assets expire and essentially draw the liquidity back. But any profits that they have, if they do have profits, they just get paid to the treasury. So they just become income of the government. They don't actually hold any reserves or long-term assets for, like forever. There's not a bunch of gold sitting there. They're not long-term investors in the stock market. It's like, that's not how it works. Any profits that they realize long-term just get, basically repatriated to the treasury. So there are definitely no reserves. Like, I'm on board with that. The question is, like, is it federal? Okay, 12 members. The president elects 7 of the 12 members. Okay. So 7 of the 12 are elected by the president. Okay. But they are elected. So I'll put that aside. Okay. So some people say, okay, 7 of 12. Well, kind of sounds federal. Okay. Dig into the details. Okay. And then there are 4 that are the member banks. So the presidents and CEOs of private banks. Okay, they're on a rotating basis, a set schedule, but like they're not elected officials or appointed officials. They're president and CEOs of private banks. Okay, and then there are regional reserves. Okay, and the Bank of New York gets a permanent voting position. Okay, so the chair of the Bank of New York actually gets a permanent voting position, and who elects the governors of the Bank of New York? It's like 6 of them are, again, banks, okay, and 3 are appointed officials who are in a circular motion, basically elected by the 7 appointees of the president. And so, but essentially, it's only 3 of the 6. So the regional banks are, pretty much they're clearly not federal. Okay. So they're, clearly 6 of the 9 are appointed by the private banks. Okay. So now there are 5 members essentially that are really appointed by the private banks and 7 that are appointed by the president. Okay. But the terms matter here. Just because you have 7 of 12, the terms matter. So the president can elect a member, and that term is now for 14 years. 14 years, okay? So that each individual president has very little decision-making power. In fact, the one that Stefan Moran that Trump appointed, that's the only one he's going to get to appoint during his term. That's the only one, okay, wow. Was that vacant position, okay? Now, he's trying to get Lisa Cook fired for mortgage fraud, okay? So maybe he gets two. I don't know if that's going to work or not. It's kind of entertaining that and
then Jerome Powell's term is done in
his term spring. Is done, but he's still a voting member. He's just no longer the chair, okay? So the president gets to appoint the chair, but it's going to be one of the voting members. So, I mean, odds on favorite now, if he doesn't get Cook thrown out, he would just appoint Moran. And oddly enough, Moran, he's like a replacement to someone else. So he actually comes up for renewal, but Trump will most likely just reappoint him. He'll just extend his term. So he's in there now. So he actually comes up for renewal next year, but most likely Trump's just going to extend him. I mean, the decision with Cook is like that, maybe he gets another one. Okay, so maybe 2 of the 7. But I want you to think about this for a second here. Who are these people that are getting appointed to the Federal Reserve for 14-year terms? Where did they come from? What industry did they come from? Do you think that they appointed a plumber from down the street to vote on this? No. Is this like, some Absolutely people from the banking industry and some from outside the industry? It's like, nah, it's a club.
They're all bankers, man.
It's a club. And where are they going to go to work after their 14-year term at the Federal Reserve?
Are they going to central bank somewhere?
Probably going to work in private banks, right? I don't think they're going to start an art studio. Like, that's not what likely they're going to do. They're not going to, start teaching piano lessons.
Or maybe like Carney, they'll go and be a prime minister or something, run for president.
So I mean, we've established the fact with the data that the Federal Reserve at this point has de facto control of the Bank of Canada. Like, their rate decisions the Bank of Canada is stuck. They can't adjust rates further, despite the obvious deteriorating job market, without future cuts from the Federal Reserve. Okay, and so is the U.S. Is the Federal Reserve? Is it federal? Does it have any reserves? Doesn't have any reserves. Is it federal? I mean, the quick argument would be like, well, 7 of the 12 voting members are appointed to the president, so it's federal. But the realist argument is like, what industry were those people selected from, and where are they likely to, after their 14-year term, where are they likely to go after? Back to the banking industry. So who are they beholden to? Okay, they have this appointment. Once they got their appointment, they don't have, unless they go out and commit some mortgage fraud, there's really nothing that the president can do about them. Okay. So, Trump is going to appoint a new chair. He's been very public about that. And that will have some influential power. But at most, Trump's going to appoint 2 voting members, 2 of 12. And guess what? The chair actually doesn't even have a casting vote. I had to look this up. I was wondering, does the chair even have a casting vote? So the 4 member banks are going to rotate through. So that's a bit of a crapshoot. Like, will they be more dovish or hawkish? No one really knows, because they're going to represent their own bank's interests, and each bank will have a different thought process onto what helps our bank. If I'm holding a bunch of bonds and the rate starts to go down, well, all my bond holdings go up in price. So that's good. But if I'm a bank that doesn't have a lot, and I'm just looking at I'm making big, huge spreads on these high interest rates right now, maybe I don't want them, right? So I would argue it's not federal. And so, the title of the video is like, is Trump in de facto control of the Bank of Canada? I don't think so. He's got some influence, but ultimately it's the bankers. And I want to show you like how this thing actually, like, what was the most significant thing that came out of this whole thing. And so this keeps reverting back, but I just want to look at the U.S. 10-year Treasury note. And this is essentially the instrument that underpins the entire financial system. Okay. And what did they actually think? This is a 5-day chart. Okay. So they're hitting lows of 4%. They're hitting lows of 4%. And what did they think about the 0.25% interest rate hike? It's like they actually liked their bonds less. They wanted more interest. Okay. So people sold their long-term treasuries, big holders sold their long-term treasuries after seeing that short-term instruments, they're still getting the 4.25%. So they're just like, why am I holding this 10-year duration treasury? The longer the duration, the more the risk. Why am I holding it for only 4%? I want 4.15%. Okay, so 10 to 15 basis points. So when the holders of the long-term treasuries, when they see that the rates were only going down by 0.25%, they didn't like it. They liked their long-term treasuries less at that point, and some of them sold. Okay, so who's actually in control of that? Who is actually in control of the rates? It's the bond market. It's the bond market. You can go from A to B to C. It's like, who's in control of the Bank of Canada? It's like, well, the Federal Reserve. Who's in control of the Federal Reserve? Donald Trump, somewhat, some influence, but who has the majority of the power? The bankers, and ultimately the bondholders. And who owns the bonds? The bankers.
Banks.
And then there's the circular, there's the circular relationship there. Okay. And so, but you do see the rates go up. Okay. You do see the rates go up, and they will not be able to go up indefinitely. Okay. That has been the entire exercise. Most people are just completely in the dark about this whole thing, and they're just thinking about tariffs and Doge and left-right rhetoric. And it's like, the bond market is the entire game, people. Like it is the entire game, that if the bond market blows up, the gaps between the rich and poor get exponentially bigger overnight. The chance of, regional, you think you have political division now. Wait till you see if the bond market blows up. You think there's global conflicts now. Wait, what would happen if, foreign countries smell blood in the water and they think that the U.S. can't finance their military, or they don't have as much to finance their military. They'll make the moves that they wanted to make all along, and some of them will just make moves just because they see weakness. And that has been the whole, do these rates need to come down? It's like, they do need to come down. They do need to come down. Bank of Canada is stuck. They're waiting for the Federal Reserve, and ultimately, whether it be Trump or whether it be the bond holders, they're going to drive down these rates. That's going to be the ultimate destination. Okay, so they're going to drive down those rates. They're going to drive the interest rates down, and it's going to make our dollars worth less. Okay. Often we don't understand it because we just see the relationship between the Canadian dollar and the US dollar. But the fact is, the value of both of those instruments are going to fall in relation to real money, like gold.
Right.